have you ever pondered the delicate balance between risk and reward in bank Nifty trading? It's a question that's likely crossed the minds of many, and for good reason. The complex dance between these two elements is the heart and soul of any trading strategy, particularly in the volatile world of bank Nifty trading. Imagine yourself as a tightrope walker high above the ground, with risk on one side and reward on the other. You're constantly making adjustments to keep yourself balanced and prevent a catastrophic fall. The same principle applies to bank Nifty trading, where the aim is to maintain a steady equilibrium between potential profit and potential loss. This balance is crucial because, in the world of trading, risk and reward are two sides of the same coin. You can't have one without the other. Each trade carries a certain level of risk, but it's that very risk that opens the door to potential rewards. And understanding this balance, this delicate dance, is key to making successful trades. But how can you gauge this balance? How can you ensure that you're not leaning too far to one side, exposing yourself to excessive risk, or missing out on substantial rewards? This is where knowledge, strategy, and experience come into play. To help you understand this concept better, we're going to take you on a journey. We'll be using a case study, a real-world example, to explore the intricate relationship between risk and reward in bank Nifty trading. We'll dissect each decision, each step, to help you understand how a seasoned trader navigates this precarious balance. We'll see how they assess the risk of a trade, how they determine the potential reward, and how they use this information to make informed decisions. We'll delve into the strategies they use, the tools they rely on, and the lessons they've learned from their years of experience. So, buckle up and get ready for a deep dive into the world of bank Nifty trading. So, how does one navigate this perilous balance? Let's delve into a case study to understand this better. Imagine a trader. Let's call them Alex. Alex is about to make a significant decision in bank Nifty trading. Picture this. Alex, a skilled and experienced trader, is contemplating a massive move in the bank Nifty trading world. They have been watching the market closely, studying trends and analyzing data. This isn't their first rodeo, but every decision in trading comes with its unique set of challenges and potential rewards. Alex's decision is based on a confluence of factors. They've been tracking a particular bank stock with a keen eye. The stock has shown a consistent upward trend for the past 6 months. But the market is volatile, and as every seasoned trader knows, past performance is not necessarily indicative of future results. Alex is fully aware that the stock's upward trajectory could reverse at any moment. The stock in question is priced relatively high, which means the potential for profit is substantial. But with high reward comes high risk. The stock could plummet, leaving Alex with a significant loss. But if the stock continues its upward trend, Alex stands to make a substantial profit. It's a classic risk versus reward scenario. Alex has also been considering the overall market conditions. The economy is in a relatively stable state with steady growth and low inflation. However, there are whispers of a potential policy change that could shake up the market. These rumors cannot be ignored, as they could significantly impact the stock's performance. Moreover, Alex is not just considering the current price of the stock. They're also looking at the stock's overall performance history, the bank's financial health, and the current economic climate. It's a complex puzzle with many pieces. In addition to these factors, Alex is also weighing their personal financial situation. How much can they afford to lose if the trade doesn't go their way? How much profit do they need to make for the risk to be worthwhile? These are personal factors that every trader must consider before making a move. There's also the question of timing. When is the right moment to buy? Should Alex wait for a dip in the price, or is it better to buy now before the price potentially skyrockets? Timing is everything in trading, and this decision is no exception. Alex's situation is a prime example of the complexities involved in trading. It's not just about analyzing data and making predictions, it's about understanding the market, the economy, and one's personal financial situation. It's about balancing risk and reward and making tough decisions under pressure. So let's take a moment to step into Alex's shoes. Imagine you're facing the same decision. You've studied the market, analyzed the data, and weighed your personal financial situation. You understand the risks involved and the potential rewards. You know that your decision could result in a significant loss or a substantial profit. Now you're standing on the precipice of a significant decision. The market is volatile, full of unpredictable twists and turns, but you're not afraid. You're a trader after all. You're used to making tough decisions. You're used to taking risks. And you know that with great risk comes the potential for great reward. This is the situation. Alex has a critical decision to make. What would you do if you were in Alex's shoes? Alex's decision will be influenced by two factors: the risk and the potential reward. Risk and reward. These two elements are the yin and yang of trading, the two opposing yet complementary forces that shape every decision. They are the scales upon which every trader must balance their choices, and their understanding of these dynamics can spell the difference between success and failure. Let's begin with risk. In the world of trading, risk is the potential for loss. It's the possibility that the trade you make today could result in a decrease in your portfolio's value tomorrow. It's an inherent part of trading, as unpredictable as the tides, and just as powerful in shaping the course of your trading journey. But it's not just about the possibility of loss. Risk also refers to the degree of uncertainty about the size of that loss. In other words, risk is not just about whether you'll lose, but how much you could potentially lose. Now, let's talk about reward. If risk is the stormy sea that traders must navigate, then reward is the treasure they hope to find. It's the potential gain that a trader could realize from a successful trade. And just like risk, reward isn't just about the possibility of gain, it also refers to the degree of uncertainty about the size of that gain. So, reward is not just about whether you'll win, but how much you could potentially win. In the world of trading, understanding risk and reward is crucial. It's about more than just knowing the definitions. It's about understanding their dynamics, their interplay, their dance. It's about understanding that high risk can lead to high reward, but also to high loss. It's about understanding that low risk might lead to lower losses, but also to lower gains. And it's about understanding that risk and reward are not fixed. They fluctuate. They ebb and flow. They rise and fall with the rhythms of the market. And just like a dancer must adapt to the music, a trader must adapt to these rhythms. They must learn to read the signs, to anticipate the movements, to ride the waves of risk and reward. But how does a trader do this? How do they balance the scales of risk and reward? Well, that's where strategy comes in. A good trading strategy is one that manages risk while maximizing reward. It's a plan that takes into account the trader's financial goals, their tolerance for risk, and their understanding of the market. It's a roadmap that guides the trader's decisions, helping them navigate the stormy seas of risk and reward. For Alex, this means taking a hard look at his own situation. It means assessing his financial goals, his tolerance for risk, and his understanding of the market. It means considering the potential risks and rewards of his decision and making a choice that aligns with his strategy. And it means being prepared for the possibility of loss, even as he hopes for the possibility of gain. Now, this doesn't mean that Alex, or any trader for that matter, can eliminate risk entirely. No matter how well crafted a strategy may be, no matter how much a trader may understand the dynamics of risk and reward, there will always be uncertainty. There will always be the possibility of loss. But with a good strategy, with a deep understanding of risk and reward, a trader can navigate these uncertainties. They can make informed decisions, they can manage their risk, and they can maximize their potential for reward. Weighing the risk against the reward, that's the trader's ultimate challenge. And it's a challenge that every trader, including Alex, must face. It's a dance that every trader must learn to perform, a balance that every trader must learn to strike. Because in the world of trading, risk and reward are not just factors. They are the forces that shape the journey, the elements that define the path, the yin and yang that drive the dance of trading. Let's fast forward to see the outcome of Alex's decision. So Alex had made his choice. He'd weighed the risk against the potential reward and decided to go for it. He'd pulled the trigger on his decision, and now it was time to see how it all played out. As you'll recall, Alex had been contemplating a trade on the Bank Nifty. The risk was substantial, but the potential reward was enticing. It was a decision that required a calculated leap of faith, a deep understanding of the market, and a fair amount of courage. In the days following his decision, the market fluctuated wildly. Prices soared and plummeted, creating a volatile environment that tested Alex's resolve. But he held firm, confident in his analysis and his decision. He watched as the market ebbed and flowed, his heart pounding with each significant price movement. After a week of nerve-wracking uncertainty, the day of reckoning arrived. The market closed, and it was time to assess the outcome of Alex's decision. Had his risk paid off? Had his gamble resulted in a reward? As it turned out, the market had moved in Alex's favor. His analysis had been accurate, and his decision to take the risk had paid off. He'd reaped a substantial reward, a testament to his skill, his knowledge, and his courage. But this outcome wasn't just about the financial gain. It was about more than the numbers on a balance sheet. This was a victory for Alex's decision-making process, for his ability to assess risk and potential reward. It was a validation of his strategy, of his understanding of the market, and of his ability to navigate its unpredictable waters. But let's not forget that this is just one example. And as exhilarating as this victory might have been for Alex, it's important to remember that trading is not always this successful. There are countless stories of traders who have taken similar risks and not seen the same rewards. The market is a fickle beast, and it does not always reward bravery or skill. Sometimes, despite your best efforts and most thorough analysis, the market moves against you. And when that happens, the risk can result in significant losses. So, while Alex's story is undoubtedly inspiring, it's essential to approach it with a realistic perspective. His victory was hard-fought and well-deserved, but it was not guaranteed. His decision to take the risk was based on careful analysis and a deep understanding of the market, but it was still a gamble. The outcome of Alex's decision serves as a practical example of the concept of risk and reward. It illustrates the potential for significant gains, but it also highlights the inherent risks. It underscores the importance of careful analysis, of understanding the market, and of being prepared to weather the storm when things don't go as planned. Alex's story is a testament to the potential rewards of taking calculated risks, but it's also a stark reminder of the potential downsides. It's a lesson in the importance of balance, of weighing the potential reward against the potential risk. And it's a demonstration of the courage required to pull the trigger on a decision, even when the outcome is uncertain. And there you have it, the outcome. Sometimes you win, sometimes you learn. Now that we've seen the concept of risk and reward in action, what are the key takeaways? In every trading journey, understanding the balance between risk and reward is crucial. This is especially true in the world of Bank Nifty trading. As we've seen, it's not about avoiding risk, but about managing it effectively. It's about making informed decisions based on thorough analysis and careful judgment. Our case study demonstrated how a trader can use various tools and strategies to analyze market trends and make predictions. Remember, the goal isn't to predict the market perfectly, but to set up a risk-reward ratio that favors success. By doing so, you increase your chances of making profitable trades over the long run. The decision-making process is another key aspect of trading. It involves not only understanding the market dynamics, but also knowing your own risk tolerance. It's essential to set your risk parameters based on your financial goals and personal comfort level with risk. After all, trading is a personal journey, and what works for one trader may not work for another. The result of the decision, as we've seen, can be either a profit or a loss. But the important takeaway here is not the outcome of a single trade. Rather, it's the process of making informed decisions and managing risk over time that leads to success in trading. It's about consistency and discipline in following your trading plan, regardless of the short-term outcomes. Remember, Losses are a part of the trading journey. They provide valuable lessons and opportunities for improvement. Embrace them, learn from them, and use them to refine your strategies. The key is not to fear losses, but to manage them effectively. Risk management, therefore, is an essential skill for every trader. It involves various strategies such as setting stop-loss orders to limit potential losses and diversifying your portfolio to spread the risk. It's about making sure that you live to trade another day, even when the market doesn't go your way. Reward, on the other hand, is the potential profit that a trade can bring. It's the motivation behind every trading decision. But remember, chasing high rewards without considering the associated risks can lead to financial disaster. It's crucial to maintain a balance between the potential reward and the risk you're willing to take. So as you embark on your trading journey, remember these key takeaways. Understand the balance between risk and reward. Make informed decisions based on thorough analysis. Manage your risk effectively. And most importantly, stay disciplined and consistent in following your trading plan. Remember, in Bank Nifty trading, understanding the balance between risk and reward is the key to success. Happy trading! We've covered a lot of ground today, and you may have some questions, and I bet I can guess a few of them. So let's dive in and clear up any confusion. Remember, no question is a bad question when it comes to navigating the complex world of Bank Nifty trading. First off, one of the most common questions we get is, what is the best strategy for Bank Nifty trading? Well, it's important to understand that there's no one-size-fits-all answer to this question. The best strategy for you will depend on a variety of factors, including your risk tolerance, your financial goals, and your level of experience in the market. However, some successful strategies often include technical analysis, trend following, and swing trading. Another common question we often hear is, how can I manage risk in Bank Nifty trading? Again, there isn't a single answer to this question, as risk management will vary depending on your individual circumstances. However, some general tips include setting stop-loss orders to limit potential losses, diversifying your portfolio to spread risk, and regularly reviewing and adjusting your trading strategy as market conditions change. Next up, many of you might be wondering, what are the benefits of trading in the Bank Nifty? There are several potential benefits to consider. For one, Bank Nifty trading can offer substantial profit potential, especially for those who are able to accurately predict market trends. Additionally, it can provide a way to diversify your investment portfolio and can offer opportunities for both short-term and long-term gains. Now let's tackle a question that might be on a lot of your minds. What are the risks involved in Bank Nifty trading? As with any form of trading, there is always a degree of risk involved in Bank Nifty trading. This can include market volatility, liquidity risk, and the risk of losing your initial investment. It's crucial to understand these risks and to have a clear plan in place for managing them. Moving on, some of you might be asking, how can I start trading in the Bank Nifty? The first step is to open a trading account with a registered broker. Once your account is set up, you can start researching and analyzing the market. It's also a good idea to practice trading using a demo account before you start trading with real money. And remember, education is key. Make sure you understand the ins and outs of the market before you dive in. Another question we often get is, can anyone trade in the Bank Nifty? The short answer is yes. However, it's important to note that successful trading requires a certain level of knowledge and skill. It's also not suitable for everyone, as it does involve a degree of risk. If you're considering getting involved in Bank Nifty trading, make sure you're prepared to invest the necessary time and effort to learn about the market and develop a sound trading strategy. And finally, a question that many of you may be pondering. Is Bank Nifty trading a good way to make money? The potential is certainly there. However, like any form of investment, it's not a guaranteed way to make money. Success in Bank Nifty trading requires a solid understanding of the market, a well-thought-out strategy, and the ability to manage risk effectively. It's also important to keep in mind that while there are opportunities for significant gains, there are also possibilities for substantial losses. We've addressed some of the most common questions we get about Bank Nifty trading. But remember, This is just the tip of the iceberg. There's a lot more to learn, and the more knowledge you have, the better equipped you'll be to navigate the market successfully. Thank you for joining us today. Remember, knowledge is power in the world of Bank Nifty trading. Stay informed, stay ahead.